Okay, welcome everyone to the beginning of the Beeper seminar series for spring term 2021. And it's great to have students back in the building, this being the first day. And today we're going to turn towards Asia, an area that is very much in the newspapers today. And I'm not talking about Myanmar, but rather China. And today we're going to hear a presentation on China's economic outlook from short to long run. And we're delighted to welcome back virtually Alicia Garcia-Herrero to give this talk. There's no one better to do so. She's the chief economist for Asia Pacific at Natixis. She's also senior fellow at the European think tank Bruegel in Brussels, that I think people are familiar with, and is a non-resident research fellow at the Madrid-based political think tank Real Instituto Eclano. She's also does a lot of additional things. She teaches at the Hong Kong Science and Technology University, as well as being an advisor to the research department at the Monetary Authority of Hong Kong and to the Asian Development Bank. Perhaps most importantly, she is a former adjunct professor at SAIS Europe when she was still living in Europe anyway, and it was great to have her. And we're so pleased, Alicia, that you've agreed to give us an address to this very important topic. So as we discussed, if you could maybe talk for 25 minutes, and then we can open it up for questions. And if I could emphasize to the audience that if you do have questions, please submit them through the Q&A box rather than the chat box. Okay, so thanks. Alicia.
Well, thanks so much, Mike, for this invitation. As you know, I love to talk to SAIS students. We have a lot of gatherings. We used to have lots of gatherings in Hong Kong for SAIS alumni, and I have to say it's a wonderful crowd. When I was teaching at SAIS Bologna, I remember it was Latin America, and that's kind of the place I used to belong, given my name. And it took me ages to be cited on Asia because of my name. So, you know, I think that says it all about the difficulties of, you know, of exploring this part of the world. You've been doing it for a long time. And we all realize how deeply you've been doing it because of RCEP and your famous article, you know, everybody quoting that article, which is very relevant for my conversation, because what I want to tell students at SAIS is that Asia is so important that no matter your name, look at me, or anything else, just jump on it. Because even if you study European studies, say, and then we could talk, if you, although it's not in my slides, but you know, don't bother about the slides. And the China-EU investment agreement, for example, it's becoming so central to everything we know that I think everybody needs to devote time to understanding Asia better. So that would be the first thing I'd like to say. And of course, Asia is not China. I'm going to talk a little bit more about other economies briefly today. But it goes without saying that whatever happens in China does affect the region massively. So in that regard, you know, and understanding, which is already very hard, what might happen in China gives you a key to understand what might happen elsewhere. It's not the only factor, but it's a very important factor. So I hope that justifies my talk here. Nobody falls asleep. And I'm going to start by sharing some slides. And this is very, you know, like just to make it more argumentative and have a few numbers. I'm sure you like numbers, but we can talk about anything else if you want during the Q&A. So I wanted to cover short-term and long-term, but then I thought, you know, if I show slides about all of that, it will take me too long. And I I thought I would talk about the long term without too many slides and just drive you through the short term. Why? Because the short term is changing. And it's changing, frankly speaking, for the worse, and you won't find this in the consensus forecast so far. The World Economic Outlook was reviewed only, just a second. Just a few, I think, a couple of days ago with new projections, but Asia was hardly influenced by that revision. So far, the idea is first in, first out. So it is basically all about China's, rapid control of the virus, and to a lesser extent elsewhere, and that goes from the best, which is Taiwan, Vietnam, and to a lesser extent South Korea, and then you move on all the way to India, basically. But that simplification, well, and by the way, and then growth in 2021 would be higher the more you had gone into lockdown in 2020. So India, terrible. So growth, ballooning in 2021, and basically an important recovery in China from 2.3 to something of the order of 8 in 2021, but not as astounding as India because it's coming from a better 2020. So this, we economists call it base effect. The bigger the base effect, the more you would recover. Now, it so happens that we are starting to see stuff not of the order of what you see in Europe in terms of new lockdowns and delays with the vaccines, but to some extent a similar pattern, just not as serious. So basically, I'm going to move to page 4 of my presentation. And actually, I'm updating this as we speak, so maybe I'll be able to send you an updated version of this graph, which we calculated on January 12th. And I was trying to have it ready for today because I have a client tomorrow, and I'll update this for you because it's very interesting. What it's showing is that basically, forget about the total cases. Of course, it depends on how big the country. So India is still in flux, but the change is small. While Thailand is seeing a very rapid increase in cases, to a lesser extent Japan, also Malaysia. Actually, Malaysia bigger since we prepared this graph, etc. So it's coming back. You have basically emergency, national emergency in Malaysia, local emergencies, so 2/3 of the prefectures in Japan, etc. We have, of course, a few isolated cases in China, isolated cases in Taiwan, even in Vietnam. So even the best in class are starting to see, if not a whole lockdown whatsoever, although some provinces, as you know, in Northeast China have been in partial lockdowns at the city level. But the point is, we're starting to see fear again. And that is something that we were not expecting in 2021, because we thought, well, it's control plus the vaccines are coming. Now, the vaccines, there's a number of issues. First, what's the percentage of the population for which vaccines have been secured? And, other than Australia and Japan, Hong Kong, so basically, developed Asia, you see that some are really, really very much down into this sourcing of vaccines. Some only rely on COVAX, so it's going to be it's going to take a long time. So say Taiwan, for example, and unless they come up with a vaccine, which they are doing trials for, it'll take really, really long time. So this idea that first in, first out might change because of the rollout of the vaccines. Well, first the sourcing, and then of course the distribution. So that's important, meaning do not think 2021 is basically over with COVID for Asia, which was the idea only a couple of weeks ago, or 3 weeks ago, so early January. It's kind of a dream. It's not going to happen. If you look at the rollout of vaccines in this graph, what you see is first again, the same data. So what's the percentage of populations with for which vaccines have been sourced, and then the plans, the actual rollout plan. As you can see, there's a number of important countries, including China, for which there is no rollout plan yet. And that's kind of strange because, well, they had been doing trials, quite, relevant trials, even before others had started. Vietnam, no plan. And I think that this already shows the difficulties, basically, with the rollout. It's very hard to plan. So, those planning and maybe underperforming may pay the price of that underperformance versus the rollout plan. And I think that is pushing now increasingly countries away from that planning, which is very scary in terms of when are we going to end with this. And let's not forget, some Asian countries have a very large percentage of the population in elderly population. So the population at risk is, of course, very high for some of them. So I will avoid all of this detail. This is a paper we published on how the slow vaccination plus the additional containing measures, even lockdowns in some countries, may delay the recovery in Asia. And although mobility has been, of course, moving up in some Asian countries compared to last year, but you see that for some, actually, not really. So, we are not out of the woods. That's what I'm trying to say. You will still see better growth, no doubt about it. Just, I'm going to move a little bit on the fact of the stimuli, but there's a number of issues here. Fiscal and monetary support might not be as, here you have, a little bit of how much it was. Of course, it's not comparable, except for Japan and Australia, to the developed world, to the West. But they've all done their efforts. Yeah, perhaps one of the smallest has been India, but other than that, I think it's going to be very hard to keep that in 2021. We just had India's budget today, and it's quote unquote underwhelming, as it should be. So, emerging economies in Asia are aware that, yes, financing fiscal deficits is easy today, but it might not be in the future. Now, zooming into China, which is basically why you invited me here, so I need to talk about China. So China, of course, recovered very rapidly in 2020. So we're going to end the year, as I said, 2.3% and a great fourth quarter. But not everything behind that headline is as positive. We wrote a paper comparing the consumption patterns in 2008, so the previous major crisis, as well as the recovery after 2015 stock market collapse, etc. And it's so much weaker now. So why is consumption still weak? Because services are weak. It's mainly the services sector. And we think that might not change as quickly in 2021 because of the fear of new lockdowns. I'm sure you follow what has happened with the Chinese New Year, which is a major source of revenue for, of course, services, restoration and traveling, and all of that is now at stake because of the restrictions on traveling. Household income is also has not recovered to previous COVID levels, and that's worrisome. Unemployment official figures is much better, but unofficial figures, including, of course, migrant workers, are much worse. And thus, we just think that even for the best of all, i.e. first in, first out China, there's still a lot of looming problems, basically, that we need to see. One is, of course, the fact that the investment of the private sectors, in particular, and manufacturing, is not back. And the question is, that's strange, because actually foreign direct investment is back. It's grown over 6% in 2020, and people are thinking China is a place to invest. But Chinese themselves, they're businessmen, and particularly manufacturing, don't see it that way. So, there's a lot of shadows in that big story. The other one, of course, is very low producer prices. They are recovering a little bit. So the phantom of deflation. And on top of that, China's growth in 2020, and this is very important for Europe, has been coming out of exports. So China has really increased exports into Europe, less so into the US, clearly into ASEAN. And the question is, can this continue? Will it be easy for China to, like November data was 23% increase in exports and hardly any increase in imports? Can that, China is going to end the year with a massive current account surplus. Can that continue? And I frankly think that the irony of things is that China's higher growth because of this external demand might be a problem. And this brings me to the geopolitics of issue of what we are discussing here down the road. Yeah, ending the year with a huge current account surplus, with a new US administration, with a new investment deal with Europe that by the way is just an investment deal, it's not a trade deal. And everybody kind of backtracking on that deal. If you hear the commission now, it's like something like, but it's not a big deal. It's just a small deal. It's just a first step. We have many other tools to contain China. It's like, we did it, but don't take it seriously kind of thing. And I think once we have this huge trade surplus, and especially current account surplus, I say especially because, as an economist, you need to realize that in the current account, there's something that has plummeted in China, which is imports of services, i.e. tourism. Yeah, because nobody's leaving the country. So current account is going to be surplus, is going to be even bigger than the trade surplus. I think people are going to look at China and say, wait a minute, we thought Germany was kind of, pushing exports. Look at this, and this is basically a state-driven economy, you name it. I mean, the story. That's what's going to be. And I think China, in a way, won't start with the best of all tools with this new Biden administration because of this massive trade, which again is not as massive for the US, and partially because China has been indeed trying very hard to import from the US all the way to the 200 billion agreed in the phase one deal. They haven't reached that level. There's a Peterson report on this, which is quite interesting, but they've gotten close to that. And that explains that the trade deficit between the US, from the US with China, hasn't ballooned, but it has ballooned for Europe. So that's, I think, an important thing to mention. The other risk is, of course, defaults. We've seen a very clear increase in defaults in China, even state-owned enterprises, which were like untouchable, and some of which are actually central SASAC, meaning central state-owned enterprises. And this is a change. We just had, last Friday, HNA, Ambang already, HNA's bankruptcy, which is a huge conglomerate. And it was not a state-owned company, but, it had a lot of support, apparently, from, some high-level officials and you name it. And there's been a lot of issues with this company for a long time. So you basically are seeing increasingly the risk, the inherent credit risk of a growth model that, in my opinion, has not been very balanced for a long time. I'm going to skip all of this to allow for questions. Don't think that because defaults in China have increased, we've not seen any interest from investors in China. All on the contrary, and you can imagine why. First, the winner of COVID being China in terms of growth. Second, and very important, China's interest rates have remained relatively high compared, of course, to the plummeting interest rates in the West, especially, of course, in the US. So when you look at interest rate differential, which you see there in gray, it's been increasing very rapidly since 2019, and that has attracted humongous amounts of capital into China. And there you see the percentage of foreign ownership on the bond market, and it's now 3.2%. That you may say is very low. Actually, it comes from less than 1%. So it's a very rapid increase. It's a huge market. By the way, it's the second largest bond market on earth after the US. Of course, Europe doesn't have an integrated bond market. That explains also why this is the case. So you can tell that in a way, COVID has been positive on China, not only in terms of growth, but in terms of attracting inflows. And you may say, why aren't all of these new defaults not like shying people away? Because foreign investors are not buying those assets. They're buying government paper or policy banks, which are basically quasi-government paper. And thus they are not affected by the defaults in general. So I think there's a reason for that. They're just going for the yield. So basically, short messages on the short run is simple. Asia, yes, first in, first out, but it's not going to be as magic as we thought it would be. The reason is the virus is not over even here. We have lockdowns, of course, Hong Kong as well, and many other places in Asia, and the vaccines are not really coming in at the speed we thought they would. That's important. And herd behavior, herd immunity, maybe India, but frankly speaking, in a place like Taiwan is 0 because they have had 8 deaths since it's good that you only had 8 deaths, but the degree of herd immunity is literally 0. So, if there are delays with the vaccine, this is the irony of things. Asia might pay a price because the herd immunity is very low in places where there haven't been many cases. So there is a little bit of a trade-off here to basically say Asia is the winner of COVID. Well, it's not yet over. So that's the key message I wanted to give. And for China, while the numbers look good and it's all, of course, to be commended, but there's a lot of creaks. Consumption isn't really back. We have defaults, big defaults lately. And yes, they're attracting capital out of an interest rate differential, but the cost of funding is high. So, that doesn't help. Now, what are the key issues long-term for China? The key issues long-term for China is that China is in the path of a structural deceleration. And frankly speaking, it's very hard to, I wouldn't say stop it because it's impossible, but even to smooth that deceleration because it has fundamental reasons beyond the obvious, which is aging. That one we all know. But aging doesn't explain the speed of structural deceleration in China. It's about literally 0.5% shelving, taking out potential growth in China. The rest is really about, if I say plummeting, maybe I'm exaggerating, but frankly speaking, because labor productivity is falling everywhere. So when I say plummeting, it gives a wrong signal that maybe it's increasing elsewhere. No, it's coming down everywhere, but especially quickly in China. And total factor productivity, which is basically where you should see the increase, the innovation that China has been accumulating, which is undoubtful, is, however, you see the money. R&D in China, research and development has doubled. It's now 2% of GDP. It's basically that of Europe. Is not yet the US. It's half of South Korea, but given China's size, it's just a humongous pool of money. And that the money's there, but you don't see the impact of that in research and development on total factor productivity yet. It's basically flat. So unless there is a delay in the impact of China's innovation on growth, which could, it's hard for me to know, China will continue to decelerate structurally because that growth, potential growth, is coming from pretty high labor, not high labor productivity level, of course, in change. Yeah. So the increase in labor productivity in China has been very fast for many years, slowing down. you can't expect capital to make it because the return on assets is increasingly low. We're close to 1.5% of GDP. So in other words, for any unit of investment you make in China, you just get 1.5% of GDP. That's basically the rate of Japan or Europe. But China was growing 6.1% before COVID. How can it give such a low return? Because there is overinvestment. We all know that. So growth cannot come from investment because there's too much investment. It doesn't seem to be coming from labor productivity. It's slowing down. And even if R&D has doubled, total factor productivity is stagnant. So there is an issue really about how is China going to grow from here to 2035. And finally, just a reminder that the 5-year plan, not yet fully announced, but of course we have the guidelines, does expect China to grow fast, at least relatively fast, because it expects China to double its income up to 2035. So just make the calculations. China will need to, it depends on what you mean by doubling the income. Do you want to control for the US growth or not? I mean, is it convergence? There's many things that we economists like to talk about, but I don't have time. What I think I need to say is that no matter how you calculate it, we're talking about average growth of at least 4%, if not 5%, depending on, again, if you converge with the US, it would be 5%. 4% on average up to 2035 might look low to you, yeah, because again, we'll have 8% this year. 2019 was 6%. You say, wow, that's easy. It's not easy because that potential growth again is coming down. So 6% in 2019 from over 10% before is decelerating very fast, and we expect that deceleration to be even faster because aging is accelerating. 2035 is the peak. It will detract 1% of GDP altogether, shave off from growth. So as you can tell, it's going to be very hard for China to keep that growth rate on average. And just a sense of, just confirming what I'm saying. And the last thing I'll say, if you read a document, which I basically really recommend to you, it's called Innovative China, NDRC and World Bank document. You have a table there, which is scary to me, where it is stated, and again, this is the World Bank and the basically, the planning and reform, national planning and reform, basically China's core planning agency. They're telling us that China could grow as little as 2.7%. I think that's the number in that table if it doesn't reform quickly enough, not even no reform. So, 2.7 in 2035 in that decade is really low. So can China manage with a growth rate of average, say, 2.4, 2.7? It's going to be hard because basically China still needs to become a developed economy, income per capita wise. So what's, the expectations, if I may say, aren't that of a growth rate of 2.7%. That's because of COVID, that's fine. But, and the rest of the world is plummeting. But if the rest of the world recover, China won't be happy with 2.7% growth. I'm not saying that's going to happen tomorrow, but this is where we're heading. So China needs innovation, and there's anything that really scares China, and you could see that from Davos, of course, speech from President Xi is tech decoupling. And anything, now we talk about the bifurcation in this interesting document that, was released by the industry. All of that scares China massively because it is all about increasing total factor productivity to keep that growth level. On that note, I leave it here. I think I've been maybe a couple of minutes more than I said I would be, but I hope I've covered most of the ground.
That's fine. Thanks so much, Alicia, for that great overview and underscoring a lot of the problems to longer-term growth in China. Also, thanks for the pitch about Asia, that the economic gravity of the world is shifting in that direction, and regardless of what our regional orientation is, it's an essential region. As people collect their questions, again, if you could put your questions in the Q&A box. Let me abuse my role as the chair to ask you two quick questions. Well, maybe not so quick. The first one was, you know, I've heard during the rapid expansion in China, somebody said, you may know Mark Nolan, sort of underscored the fact that, look, you've got China with this rapidly growing labor force and, you know, investment flows of 40 to 50% of GDP. You'd have to have really bad productivity growth not to have very large growth numbers. And from what I hear you're saying, if you are in a situation where the labor supply is, you know, aging and you've got this problem with the demography, you've got a deceleration of investment growth, then TFB does become the major issue, doesn't it?
Yeah.
So in any event, and linked to that is this, you mentioned the term, the structural deceleration in China. Do you think from a policy point of view, there's the fear of a return to state-led growth? In other words, it would seem that the, you know, President Xi administration, unlike other ones, seems to be going backwards in that regard. Do you think that's going to be a big challenge?
Yes. Well, first of all, thanks for the very interesting questions. I think both are in a way related. Why? Because yes, it's all about TFP, and that China knows this in and out, because any other source of growth, you know, if you do any kind of growth accounting, it's pretty obvious. So labor is, you know, contributing less, and less so all the way to 2035, increasingly so. Labor productivity, you know, you can't be as productive because before there was a catch up in labor productivity. That's why it was growing so fast. But you cannot keep growth of labor productivity at that rate, because you are becoming increasingly, you know, like any other country. So you just can't. You have already, China has close to 57% of the population already, you know, from the, having been urbanized. And we know that in the next 5-year plan, they will push further, but there's a limit, because say Brazil and Mexico with these mega cities are between 65 to 70. So they can't go beyond maybe 70. So there is a limit to easy increases in productivity. This is not India. India still has a long way to go, but not China. And they know that in and out. So basically that helps, say, the next decade. But once they're there, labor productivity is going to collapse, because there's no transfer from a low productivity sector to, you know, this is Lewis. I mean, Science students know this better than me already. I mean, I learned it when I was young. But point is, that's the key. Yeah. And then you move to investment. I already said that investment to GDP ratio is humongous. And the return on that investment is very low, and it will continue to be low because they've basically done everything they needed. And of course, one can argue they need more, you know, digital infrastructure. Yes, sure. But the point is, digital infrastructure is not, I mean, this is in billions of renminbi, if you see what I mean. It's not the same bulk of money than building the whole country. And thus, it's going to be very hard to keep that going. That's total factor productivity. But so far, we don't see an increase in total factor productivity. One reason is related to your second question, because we wrote this paper. I mean, you know, all of these papers we write sometimes. I mean, these are like investment banking type papers, so they're not very, like, you know, professional. Let's put it this way, not very detailed. But I remember I got called by so many people because of that paper, because the whole idea was that, okay, I don't know why innovation is not very productive. Nobody actually told me that was wrong, because there's so many studies, the conference board, that, you know, even Chinese academics are showing that total factor productivity is not really shooting up. But, you know, the problem with that paper, or what caused a little bit of problem, is that I was arguing that maybe the reason is that most of that innovation is financed by public money. Basically either SOEs or directly by, you know, like local governments financing indigenous innovation, which means only Chinese companies. This is what it means, indigenous innovation. etc., etc. And that maybe those funds, and we saw that with the semiconductor industry very clearly, they created a 60 billion US dollar fund. And, literally, if you were producing washing machines, you would just apply for it because, it was easy money. So, that is not a productive way to increase productivity in the semiconductor sector, to be frank, because a lot of that money is spoiled. And I think, in a way, the two questions go together. I think China's economic model might be great to control COVID, but might not be great to innovate. And I'm not saying China is not innovating. I'm just saying that it is costly to innovate, meaning that it is expensive because there's a lot of slack in that particular model of innovation. And that's where I leave you. I hope I answered.
Yeah, no, interesting stuff. Now, okay, so let's go to some of the questions that people are submitting. Again, please submit them to the Q&A box. The first question is, what is the outlook for BRI lending? Obviously, the ability of developing countries to borrow is limited after COVID, but what about China's ability to lend? Are there tightening structural constraints here?
Very good question. Well, I've been looking into this topic because I think it's very important. So I have to say I had, this was well before COVID. So January 2019, a meeting with Carmen Reinhardt. She was writing this paper with Trebesh on, lending into BRI. And they were already seeing the deceleration. Because the deceleration doesn't start with COVID, it starts with the trade war. Because China realizes that it needs to stimulate the economy. And the way to do that is to keep the credit indoors, put it this way. Yeah. So they already in January 2019, they pushed banks to lend to the private sector massively. It's a long story. It was a carrot and stick kind of strategy to do that. But the point was that they were started to try to divert funding from overseas funding for domestic funding. Even policy banks, which, as you surely know, are the big arms of cross-border lending for China, and in particular for BRI, they just tried to keep as much as possible for domestic projects. So there was already, before COVID, a little bit of tightening of conditions for all of the countries on the BRI plus African countries, and they already suffer from that. Then when COVID came, that was really a sudden stop. So I remember with Carmen Reinhardt discussing the likelihood of a sudden stop because the deceleration was quite weak. And, well, of course, I couldn't think of a pandemic, to be frank. I thought that it could be like a chain of defaults in China. I thought, like to avoid that chain of defaults, they could suddenly try to repatriate as much as possible. And we were seeing that, frankly, and again, with the collapse of bankruptcy of HNA, if you follow that case, you can tell they've been divesting many of these groups, Ambang, from investments overseas, especially in the West, massively already. So it's not only the policy banks and the BRI, it's also the private conglomerates, in the West, which have been divesting at loss, in many cases at big losses. So why? The question is, are there tightening structurally? Well, I don't think structurally, because I see now, like in my investment bank hat, although I just do research, but I hear, they are thinking the world is on sale, basically. So, this is the time to go and buy. But this is M&A. This is not lending. China tends to do M&A, buy stuff in the West. By West, I mean literally, the West, the way we know it. In the Middle East, Israel. And then in Asia, Singapore, literally. In Japan and Korea, they can't. But it's like literally the safest places, rightly so, because you own the project, yeah, and then you lend to the rest, project finance. That's the model. So I think they will continue to invest because prices are down, and not everywhere, but some sectors, maybe not. For some, they just can't buy because Some sectors are protected more than before. But lending into BRI, I think they'll be very cautious. And the reason is, first of all, will they be repaid to start? Yeah. I mean, some of the lending has to continue because to restructure the debt, they need to maybe still, put some money in so that, the flow continues. But I don't think there will be net, if you see what I mean, new lending. First, it's risky. Second, the population is against it. The BRI has a very bad name in China now. It's like, why are we doing this? Why? I mean, our country has issues. Why are we doing this? So, politically, it's not easy. And in fact, if you look at the name, I mean, BRI is not even in the guidelines of a 5-year plan. It doesn't mean it won't be there. But it's like, of course, China Manufacturing 2025, not there. China Standards 2035, not there. That doesn't mean it doesn't exist, yeah? But it will be much slower for the BRI lending part that you asked. I hope I answered.
Oh, interesting stuff. Let me ask, wait for a few more questions. You'd mentioned that there's been an issue with growth in domestic Chinese investment, and yet FDI seems to going into China seems to be pretty strong. As a matter of fact, I believe last year that UNCTAD reported that for the first time, FDI in China was greater than FDI going into the U.S. Is it what is this due to? Is it that the Chinese know something that the foreign sector doesn't know, or what is it? Do you think?
Well, first of all, FDI indeed in 2020 increased 6.5, I believe, % in China, which has been on a decelerating trend. So it's quite a change in pattern. I think, first of all, I mean, the mantra is China is the one and only place to invest because that's the one and only place which will be growing fast for the foreseeable future because of COVID. And, it's like that's, and people are cutting down on, so for example, German automakers. Yeah, I mean, the figures show that 2020 was all about China. So, what are they going to do? Invest in China. So I think that explains part of it. The other reason is that an important sector, finance, was closed before. Yeah, that you had this limit, 20% for a single investor, 25% for joint investor, blah, blah, blah. And they opened that. Well, as you know, ex-President Trump pushed for that quite aggressively in his last trip to China. I think it was January, maybe 2019, if I recall. I mean, during that, so China opened up, yeah? Actually, President Xi pre-announced that opening, but I think it was already agreed that was, part of the solution to the trade war, etc. Long story short, that sector has attracted quite a lot of new investment. So we just had Allianz announcing the full control of an asset management company in China. We had quite a few, JP, Goldman, BlackRock, you name it. So, all of that is a new flow of investment, which you didn't have before. So all of that explains the pattern. But, and of course, the foreign investment new law, which makes it more clear which sectors are closed, the negative list, and which this law was enacted on January 2020. And now everybody wants to be the hero of that law, if you see what I mean. The European Commission with the Comprehensive Investment Agreement. Thanks to that, we have the law, not really because it happened before, but anyway. The US negotiators with the phase 1 deal, you name it. But the reality is China was on track to do that. Because having a positive list, in the 21st century is like, frankly, impossible to keep. It took them forever because what they did smart. I don't know whether smart, cheeky, tricky, I don't know which word to use. They applied the negative list only to some cities, the free trade zones. Shanghai free trade zone is like 2 square meters. I mean, I'm exaggerating, but you can't claim you have a negative list only on a minuscule part of your economy. Then finally, yes, the US pushed and they extended it to the whole nation, to the whole. But they still have 33 sectors in the negative list. So it's not, if you ask me, I think companies will start realizing it's not really open. They know it's not open, but they have no choice. But if one day India really opens, which to me is like increasingly unlikely, but say one day, I mean, if we have more open places of the size of China, or not size, potential size, I think not so many will remain because it's still fundamentally closed for many sectors. That's my take on this.
Interesting. And you know, I have to ask you a trade question, of course.
Yeah.
Beyond RCEP, you know, Premier Li last May mentioned the possibility of China's joining the CPTPP. President Xi mentioned that in his APEC discussion about that possibility. And actually, I understand the CPTPP is now available in Mandarin. I know people that think that this is significant, and others who think this is just it's just smoke. What do you think?
Well, I'm going to be, I don't know how open I can be, I guess, very open. Your size. To be frank, well, I don't know if you saw that the UK has announced it will start negotiations on the CPTPP.
Yeah.
Just, I mean, which is interesting. I think, you know, it's like El Dorado. Since I'm Spanish, I can say that. El Dorado, there's nothing better than CPTPP. But the reality of things, I mean, I don't know whether you follow these negotiations closely, meaning the Japan-led negotiations. But what I heard, and this is from Vietnamese friends in the government, that this is the word they use on the SOE chapter, easy peasy. I thought, well, that's interesting. Japan had to pull this together. Let's face it. And at that time, the thinking was not, the bar has to be high enough for China not to enter, because it wasn't even in the cards. So my impression, but you are the expert, is that SOE chapter is not as difficult, and China knows it. Mm-hmm. And by the way, I mean, I didn't read the final version, but I did read the TPP version. I mean, the one that then, the Trump administration threw out of the window, but that one on SOE, the chapter on Vietnam and Singapore. And it looked easy peasy to me already then. Mm-hmm. Because, to accommodate Vietnam and Singapore, you need to be pretty lax on this issue. It's not easy. So, I think that, well, another reason why I think, to answer your question, I think China can, if push comes to shove, get into CPTPP. I think China will only do it to corner the US if needed. But if it doesn't need to do it, it won't do it. It's just, now, Europe claims, the European Commission claims that they've done wonders on SOEs in this investment deal. Actually, they've only covered transparency, nothing else than that, which is fine, because if you go to WTO, at least, you can ask for the data and then decide whether you do countervailing duties or, you name it. Yeah, basically, it's better than nothing. But they've not moved beyond. There's nothing that really, there is no dispute settlement mechanism that allows you to basically, beyond the WTO, do something about SOEs. So I think China is getting used to your question of kind of acceptance. And, let's face it, Europe will have maybe more SOEs than public companies than China. I'm exaggerating, but frankly, it doesn't look very promising, yeah? You see, so in a way, China, in my opinion, is thinking, it's a car I have. If I need to use it, I will use it. The cost will not be as high as it was before, because everybody's moving towards my model. Maybe not the US, but certainly Europe and, certainly India. So, why would people point on to me if this is what's happening globally? So again, it can happen if they decide it is strategically important. And frankly speaking, if the UK tries to join, it's a very good time for them to just jump on the bandwagon and say, you have an applicant, there you go, you have two. You know, why not? And how will the US react to this? Or even Europe, because Europe doesn't have it. I mean, yes, it has trade agreements, as you know, South Korea, Japan, Singapore, you know the story. But is Europe going to start negotiating separately with ASEAN? Are they going, I mean, China is just an investment deal. So in a way, it's like China is carving out Asia, if you ask me. You know, and I think in that regard, CPTPP becomes very strategic because it's like closing the door for others, you know. Now, there is a poisonous pill, as I'm sure you know, which is Mexico. Because Mexico could, in principle, veto China. Now, of course, you may say, wow, but as I'm sure you know, Mexico was the last country to lift the veto on China's accession to the WTO. I guess the US forgot to tell them to lift the veto. So they were the last one. Actually, ironically, and this I know from a good source, it was great for Mexico because they got a huge exemption. I mean, you know, for basically tariffs on imports from China, because, you know, they had to compensate them to lift that veto. Now, will Mexico exercise? I mean, the pressure will be humongous, but maybe Mexico will obtain stuff from the US that it would never have. You know, like it's complex. It's like a chess board. But I would not dispel that idea, Mike, that China enters or applies now with the UK. Imagine the face of the UK. They open the door, China squeezes in, all in tandem for the negotiations. My God.
Imagine the US if that happens.
Yeah, I mean, the US is like literally, yeah, I know.
But I think it's going to be tough for the UK as well. I mean, the advantage of going in now is that labor chapter is suspended, and so that leaves an opening. I can't see how the UK can join without having a labor chapter that has teeth, because its left is going to be
yes, but you know, the US, in my opinion, the UK is in such a situation trade-wise that, you know, I don't know. It's not that they have many options, frankly speaking. China is not going to negotiate with the UK because it is really expecting the EU to announce, and the US is going to be very hesitant, starting negotiations for FTA, because the idea they had is 2020 BIT, which is now CAI, this Comprehensive Agreement on Investment, and then 2025 FTA. And, you know, these plans they do on papers, like they have to hold no matter what happens. So I think they won't negotiate with the UK. And that means the UK has to do something. And by the way, they could always argue that the labor chapter that the EU, with its almighty negotiators, has signed with China is something unheard of. Yeah, they could say that. So it's like this, in my opinion, it's like, well, already Vietnam was a little bit of a, or even South Korea. Now you probably saw the, what's the name? The panel of experts decision on labor rights in Korea. I mean, basically supporting the EU's call for kind of not breaching, because it's not a state-to-state dispute settlement, but it is relevant. It's shame on you, Koreans, kind of thing. But that's why China, I mean, the China chapter is like nothing, because they saw the Korean case and said like, never on earth. So there's nothing on right of association, nothing. It's just basically forced labor, and it's only something like, I will strive to, you know. So the UK has the bar, if you see, is lower for the UK, in my opinion.
So, okay, the next question from the floor. How will dual circulation affect China's trade relations? Will it look like domestic protectionism in high-tech sectors and boost its current account surplus? Can it really boost domestic consumption to drive growth?
Yeah. Well, I wrote a piece for the Nikkei on this, and I was smashed by Andrew Shen. You may know Andrew Shen. My piece simply said, well, I didn't choose of course, the title I didn't choose. It was a little bit aggressive, Nikkei Asia Review style on China. Something like, dual circulation is good for nobody except China. Something like that. But the point I was trying to make was really that this is about this is obvious now because everybody has talked about this, but self-reliance, it's not about rebalancing away from exports, but actually rebalancing away from imports. The difference between, Prebisch and Xi Jinping, sorry to say, is that rightly so, China has a huge export machine and a huge production capacity. So if they can do it, while Latin America in the 70s was just a joke. Yeah, it was a stupid import substitution strategy, but China might manage because it just have to ensure that it upgrades so that the bottlenecks it has now. So it's about eliminating the bottlenecks. It's not about not importing. I clarify that in the article. They may import huge amounts of commodities if they are not dependent on a single source. You see what I mean? It's all about not being dependent from anybody on the high end, or even on, especially on the high end. So that's what they are achieving. It's not about not exporting. So in fact, that's why it's dual circulation. First, you keep your domestic demand for yourself. You try to import as little as possible, especially when it's something that you could depend on. And then you can be strangled, and the other one is you export as much as you can. Why not? So is this a sustainable model for the rest of the world? In my opinion, no way, because you cannot have an economy of the size of China with current account surpluses. By the way, China, people compare it to Germany. China is much bigger than Germany. It's basically as big as the whole European Union. So you can't have a current account surplus of 5% every year. It's impossible. I think that's the problem, that this, and by the way, they are already, and this is Andrew Shen's response, changing the meaning of dual circulation. So his response to my art, actually he quotes that, so I have to say, is, no, this is not a theory like Santo Tomás de Aquino, Santo Tomás de Aquino. No, it's not a theory like an exoteric theory. It's a process. It's a process to to source enough technology so that we can be technologically independent on the face of a US, of a bullying US, the story of it's the same thing. Whether it's a theory or a process, I don't really care, to be frank. But what I know is that China is trying to reduce its dependence from the rest of the world so that it cannot doesn't get stuck in its development. And frankly speaking, it's understandable. There's nothing wrong. Nobody's saying it's like immoral. It's fine with me. But I do think that's what dual circulation really means. So they will boost both exports and domestic consumption.
Interesting. Okay, well, there aren't any more questions right now. So I guess what's left is to thank Alicia for a wonderful talk, very interesting. And I hope that we're going to be able to welcome you back soon, and who knows, in person next time. So
indeed, I'm missing, the wonderful restaurants in Bologna. So as soon as I can, I'll be there. Thank you, everybody, for your time. It's been a great pleasure.
Okay, thanks, Alicia. And good evening. It's pretty late there, isn't it? So.
Yes, 8 o'clock is fine. Thank you. Bye-bye.